A large part of what I do with my business is helping small business owners and other individuals have a better understanding exactly what's going on within the market at any given time, but also just what happened in the economy. And one of those things that I look at is the velocity of money. And you can take a look here. It's going to be from the Fed. We're going to be bouncing around today, a little bit different than we normally do, folks, because I've just got a lot of little indicators I want to talk about today that they're telling about where we're at within this economic cycle. And frankly, one of the things that I'm talking with my clients about is that we are getting near a decision point. Like it is either going to break one direction or the other. And if it breaks, it's going to break, and it's going to be very severe, good and bad, good or bad when it does break. Again, those that don't know, my name's Ryan. I'm a business coach that works out of West Michigan and around the country. And I come on YouTube Live pretty consistently every single day, just sharing information I share with my clients. And this is an example. So this is from Fred. This is from the Federal Reserve. And it has to do with the M2 money stock. What does this mean, right? It's just the velocity of money. And it's a way of measuring how well things are, how many times a dollar is turned over in the economy. And what we want to be is somewhere up in this area. See this, where it's nice and stable and it's kind of hanging out. And then all of a sudden we had this bounce. And if you'll notice, the velocity of the money has continued to drop down. So when we are old folks like me, I'm 47. And when we say that, hey, our dollar just didn't go as far as it did back when we were kids, like in the 90s, it was just, we were leading into the 90s. It was something happened, something broke. And this shows you exactly what ended up happening. We had this great expansion that occurred where all of a sudden all this new technology came in, is what we're seeing here. And since then, and what I would say is excess government spending and excess borrowing, and that money has been cheap, we've been flooded with all of this capital. So our dollars aren't turning over as much, which means they don't have as much power as they used to, right? And so this is what we're dealing with in the retail space as well. And that's kind of what we're going to chat about here is when your dollar doesn't, again, it doesn't turn over, doesn't have as much power as you want it to. At some point, you start making decisions with your discretionary cash, right? Your capital that you have just as an individual, but also as businesses. That's what we're at. We're at this point right now where businesses, some industries are doing just fine and they're cranking along, and then many others are in the middle of this transitionary period because of large language models, what it looks like for home delivery, for retail, etc. Right? There's just that we're coming out the other end of this and we don't know what it's going to look like. So with that, businesses aren't investing money, and then because you have customers who are also not spending money, and they don't have the money to spend because now for hard assets, again, where you're talking about either through your buying a home, getting a vehicle, or if you're renting both, it still has a cost associated with that is eating up your extra capital. That's what's really showing up here, right? That's really what that whole thing kind of means. There's more to it, but when I'm looking at it, I'm always want to see, okay, what's the velocity look like? So anyways, we've got some articles here we're going to take a look at today. I just kind of bounce around because they're covering certain aspects. And for me, when I'm working with clients, it's rarely ever one thing. We're looking for a whole bunch of individual dots, right? Or as like I like to say, you're building mosaic. So it's small little colored tiles that we're just placing around to try to get a better idea of what's happening. So in this case, Wall Street CEO sees some tariff impact filtering into customer behavior. Well, what do they mean? Well, I thought we heard it hasn't shown up here. Now, let's hear what they have to say here. We've seen pauses in CapEx and hiring among our clients base. All of that said, the strength of the U.S. economy driven by American entrepreneurship and healthy consumer has certainly been exceeding expectations of late. So what does that mean? Businesses aren't hiring. And even though we have plenty of jobs that are out there, everybody knows there's a million people hiring for them. So like we've got an abundance of people. There aren't really the jobs out there anymore that people thought they were going to get. And we're at this other spot here where they're not going to be spending money on businesses and buildings and other equipment because they don't know what's going to happen. So that's what's happening on the business side. And then With this, the bank expects consumer spending to cool in the second half, not if a spike in prices occurs, when it does. We're just now at the point where tariff expenses are showing up in the supply chain right now. Yes, there was the initial on the like the really like small niche level stuff as far as the ordering. We did see that they were there where we did have the tariff spike to occur, like a lot of stuff you see on Etsy, and even for some smaller items that have a high turn, you've already seen the tariff impact on those, but not very much stuff. Now we're going to start seeing in the larger components and the larger items that take, that need a lot of equipment to get put together. So we're going to start seeing that here. Now they found ways, like I said, not to pass the 10% on, but that's not going to be the case anymore, which leads to, and this next one here, which I wanted to talk about, again, links to all these are going to be in the description, so be sure to go check those out. Target downgraded and Dollar Tree upgraded. Why? Well, for the reason, very simple reason, they expect that as we move into, currently they're seeing it in the numbers, but also as we move into the second quarter, that people are going to continue to trade, going to have to unfortunately buy down. We've already seen where they've been doing buying down, like Target. That's the reason they're downgraded, because people are downgrading to Walmart. Well, now they're getting to the point where Walmart, they're having to downgrade even further to Dollar General and Dollar Tree for many of their items. As we see those are going to have basically a rippling impact on manufacturing within the country. You're going to continue to see, whereas the tariffs are more and more absorbed into our daily lives and our day-to-day spending, that those prices are going to go up, which is directly affecting retail, which is, again, why I've got on the the thumbnail for this video and just talking about it, is that around the edges, retail sales are in trouble, and they are. This has been in many of the tourist areas, right, where people are traveling. They depend on the vacation money from people coming to their second homes or whatever. I mean, it's down almost 30% in a lot of the areas here. And then you go but the places that are winning at a very high level. Okay, so you see people where they're spending money on the places that they want to go to. What we're seeing in our area, frankly, is that we have folks who are spending, who are coming here to their second homes. They're not staying. They're coming up to visit for a while, and then they're right back to their regular homes, instead of what they typically did was they'd be up here for months at a time and then they'd bounce back to their primary residence, every couple of weeks just to check in or whatever. We're seeing basically it's flipping. So what does that mean? Less money is being spent all around at all the retail areas here. Okay. So we've got that spot here. And then the last one that we're seeing here is more on the outside here is AI isn't coming for your jobs from Fast Company. It's coming for your whole org chart. What we're seeing, and again, go check out this article, it's really worthwhile, is this piece right here, where they're showing this visual where the ladder, the career ladder has been absolutely shredded. Let me give you an example of what's happening here. And this leads into why people aren't spending money. Last month, my friend Amy, a mid-level marketing manager at a Fortune 500 company, had her entire junior analyst team restructured. Why? Strategic realignment. The reality, AI tools now handle what used to be 3 full-time positions. AI has eliminated 76,000 jobs in 2025, and 41% of employers plan to reduce workforce in the next 5 years due to AI. All right, so this is the final piece here. Let's say you have a stable job, right? We're not worried about getting in. You got a stable job. AI probably isn't coming for your job, etc. However, do you feel comfortable as an employee right now with your job, knowing that AI, that you're seeing people getting laid off all over the place because they're losing their work? Do you even feel comfortable as an employee? How can you? And when you don't feel comfortable about whether or not your next paycheck is going to be coming in, what do? You don't spend, you save up, you have a stockpile of cash, and you start doing things that people do to protect themselves. With that, this is going to be the next leg down that we should be experiencing within the economy. Because we have people that they're not spending money because they're worried about losing their job. You have people who are losing their jobs. They're not spending money. And then I guess one more leg down, and then we'll kind of wrap it up here was the last bit. And I don't have anything for it. All of those student loan payments have started back up or are starting up within the next 10 days. So all of those student loan payments are going to be coming out as well. So more capital that is coming out of the economy. With that, so what does all of this mean? There's a couple things that can occur here, and it can turn on a dime, right? This is just the way this goes within economies. If nothing changes and the Federal Reserve does nothing as far as for the interest rates and things just continue on as they are, we're going to see a slow decline into whatever malaise, or I don't know if we'll go full recession, but we should see a definite basically a retracement of what we've gained as far as in the stock market, but also in the economy over the last couple of years. What I would also expect to see is, we're going to have that part going on right down there. Or if it is bad and it is a full recession, then things are going to get even worse, which means we're going to have a very, 6 to 9 months of terribleness, but that will spur the Federal Reserve to cut rates, which in a year should have investment back up, and we're back off to the races. So there's that side of it. But if they decide to just raise rates, or cut rates, excuse me. So the Federal Reserve comes in, and let's say Powell he resigns, and the Besant guy gets in or whatever, and they go ahead and they cut rates. We're going to see inflation on the likes that we haven't seen since, well, it'll be back to 2022. It'll be our second round of massive inflation coming, because there's going to be more capital going into the system, which, if I bring back up our velocity of money here to bring this full circle, right now we're starting to see the velocity come back down again. Well, here is when we saw this jump up right here, that is where we saw all of that inflation come into play. So here's my big worry that I'm seeing coming out here, is that we are going to not see a full recession. I don't want there to be one, but I don't see where maybe we're not going to have a full recession, but we're still going to have rates cut, which is going to ramp up inflation, which is going to destroy our small mom and pop retail section. So that's what I see coming up right now. And that's my biggest worry for my clients, but also just for my community as a whole. Their inability to keep up with these bumps in inflation is going to be the downfall of basically Main Street this cycle. So what can you do on this, folks? Biggest thing is that you need to work on making sure that you have built a place that is, and a place that you work as your business is 100% focused on delivering the best service and products to your customers that you possibly can. If you focus on that, there's a good possibility that you can make it through whatever's coming. Now, hopefully it's going to be a blip. We'll work it through the system. We'll see the velocity pick back up in a normal, slow rate, and we'll be able to absorb this and be just fine. But all that being said, I don't think there's much of that happening. I think it's going to end up being a shock, and we're going to see inflation go through the roof. Okay. So with that, not exactly my happiest, shiniest, brightest ever video, but this is just what I'm seeing in the data, folks. And I hope I'm wrong. I really do. I'm like anybody else. I'm fallible. So yeah, at the end of the day, I hope I'm wrong, and we don't have to deal with any of this stuff. Okay. So with that, if you'd like to learn more about how I help businesses basically manage their way through this type of event, which I'm doing with my clients right now, and prepare them